Would you like to keep more of your money without paying taxes and keeping things legit? Look, most of the tax code is about how to legally avoid taxes. And in this video, we'll discuss a few simple strategies that you can implement not just this year, but in fact today, to reduce your tax burden. And if you're new, I'm Michael, a college economics professor with several side businesses and investments. I've always been interested in keeping everything legit and being the goody-goody two-shoes, maybe due to childhood trauma, but also minimizing taxes ever since I was an adult, working as a temp in tax compliance at a stockbroker's, where I saved the company almost 6 figures in just a few hours of me working a minimum wage. So let's get straight to seeing how you can take advantage of the tax code. And no matter whether you're living in the US, in Ireland, or elsewhere, it's likely the concepts here apply, though some of the particular terms may change. I'm not a licensed tax advisor, so this is not tax advice, and if you need tax advice, you should consult a licensed tax advisor. Okay, first to get our terminology correct, this is not tax evasion, this is tax avoidance. Evasion is illegal, avoidance is just legal means to lower your tax bill. So first I'd ask, do you have a company? LLCs or limited liability companies can cost you about $100 on average depending on the state to set up, and you may be able to get deductions if the company is set up legitimately attempting to make a profit and revenue. So are you teaching on the side? Are you driving an Uber on the side? Are you cleaning on the side? Any of these kind of side hustles you might think about doing as an LLC, then you can make certain claims. For instance, home office expenses. Let's say the percentage of the overall square foot in your home and your accommodation that you're using as your office. It could be that your home office is 10% or 20% or 25% of your overall accommodation. If so, and you're spending, let's say, $20,000 a year on rent, utilities, etc., you can subtract 20-25% depending on the size of your relative size of your home office. You can subtract that percent of your bills from the revenue that's taxable, essentially from your side hustle. So this is a great little thing that's something like the home office expense, and you could ask your tax advisor about this. If you have a car and you're using your car to basically try to make money, it could be just going to and from the business, or it could be just like trying to, whether it's going to drive out to basically do some cleaning job, or as an Uber driver, of course, or lots of other jobs as well. You can use, let's say, miles or depreciation. If you're using miles, you might use an app like I use, for instance, Everlance, which can track your miles, can be quite fun. And that will help you in terms of, let's say, the fuel that you're using, right? Because you can get a deduction for the fuel that you're using. Also, if you're in education, any level pretty much, you can deduct educator expenses. That's about $300 a year. Don't even really need to have an LLC for that. But if you do have an LLC, of course, you get a ton of other business expenses. One example would be going for meals. If you have a significant other, or friend, family members, etc., and you have a discussion during the meal about trying something that might boost revenue for your business, of course, it's a good idea to jot that down, but you might be able to then deduct that meal as a business expense because you and your significant other, or you and your friend, you and your family member, you went out to basically have a meal to discuss your business, try to boost revenue, etc. So that could be another way, another source. So again, check with your tax advisor, but just want to think of these concepts because these can be really, really helpful in terms of lowering your overall taxes in a given year. And you want to keep more of your income. I mean, who doesn't want that? So looking in terms of investments and tax, you could think about your regular retirement account, something like a 401k or a 403b if you're in a nonprofit or university. You could also think about an SEP-IRA if you're self-employed, or a Roth IRA. So the 401k, the 403b, the traditional SEP-IRA, typically speaking, you don't pay tax, you put the money away, and then when you withdraw it many years from now, hopefully, you won't pay tax at that point. So you pay tax on one side, not the other. A Roth IRA, you pay tax at the beginning, not at the end. So it can grow tax-free, as opposed to a 401k, 403b, SEP-IRA, where you don't pay tax right now, but you will pay tax in the future. So you got to choose whether you think you're going to pay higher taxes in the future. If you think you're going to pay higher taxes in the future, it might be a good idea to have your more conventional 401ks, 403bs. But if you think you're going to be paying higher taxes in the future, then maybe you want to think about a Roth IRA, something like that. You can also convert the 401ks, 403bs from their traditional source to a Roth 401k or Roth 403b, where just like the regular Roth IRA, the Roth 401k, 403b, you're actually paying the tax now, so that many years from now, you can let the actual investments grow tax-free and you won't pay any tax in the future. So that can be something for you. If you're lucky enough to have higher incomes, then you'll notice that the Roth IRA has a cap typically in terms of the maximum amount of income you can be earning before you're no longer able to save or put money away in a Roth IRA. Now, if you're lucky enough to have a higher income, you might notice that you cannot contribute to the regular Roth IRA once your income rises above a certain limit. And in fact, it starts to reduce over that limit until it goes away pretty quickly. So there's a little threshold. However, there is a mega backdoor or rich person's Roth IRA where you can basically take after-tax income, convert it into an IRA, and then once you've announced that, you can then put it into a Roth IRA specially. So it's you want to consult with your advisors, whether it's your tax advisor, there's usually a form, or whether it's also your brokerage account as well. So they usually are able to help you with that. So you can consider that the Roth IRA, there's legal ways around still contributing to the Roth IRA even when you go above the limit, the mega Roth IRA, the backdoor Roth IRA. Now there is an absolute mega one as well, where, for instance, if you are allowed have voluntary contributions, let's say to the 401k or a solo 401k if you're self-employed, this is typically more difficult in the 403b, but with the 401k, if you have a certain conditions are met, you're able to contribute a lot more. Now, I'm not going to go into the full details in this video, but instead of, let's say, if it's 23,000, roughly speaking, you can basically put up to 69,000 across all your accounts. Now, 73,000 next year, according to catch up. These numbers are going to change over time, but it's a lot more than what you can regularly contribute. So this could be an interesting thing, for instance, if you have a solo 401k or an SEP-IRA because you have a business, this could be what you want to do. You might be able to contribute this. Now, as a business owner, you can pay yourself an income, and then 25% of that you can put away into something like a SEP-IRA. And typically speaking, across all of your accounts, your 401k from your job, as well as, let's say, your solo 401k from your side business, you can put up to about 69,000 this year, and then 73,000 if you're catching up. Now, you also have a BIA or business investment account that you can contribute to if you have a business to put some money away. But something that's really cool, like the Marvel superhero of accounts, is known as the health savings account. Now, if you have a high deductible healthcare savings plan, you can open up one of these HSAs so that you can save inside this or invest inside this, just so that you get some money in case of a medical emergency where you have a higher deductible. So the amount of money you've got to put down first before the insurance kicks in is a little bit higher. So the government then allows you to open up one of these accounts called a health savings account, not to be confused with an FSA or a flexible savings account, which not as good in my opinion because it goes away between this year and the next year. You can't really carry it over. Whereas the HSA, you can put a few thousand in every year, and by doing so, you're able to basically grow this tax-free, as well as it comes in tax-free. So you don't pay taxes going in and you don't pay taxes coming out, provided that you're spending the money that you take out on medical expenses. Now, you could keep the receipts of things that you spent on medical expenses from the past and just provide those receipts in the future. So you could just use your regular cash today to pay for an expense, keep the receipt, and 10, 20, 30 years from now, you can basically claim that and you're able to take that amount out of your HSA without any penalty. So again, the rules get quite complicated, but the HSA is like the other accounts on steroids. Of course, there's certain limits in what you can spend, but what counts as health spending is quite generous. You may be able to get, let's say, you're probably pushing it with a massage or with spa treatment, but there's a quite broad range of definitions about health spending. So again, check with The specialists check with the medical teams, check with your tax advisor, but think about the HSA, or at least bring these ideas up. For those that are investing in the stock market, in a given year, you can basically claim up to about $3,000 in losses, and you can roll this over like tax loss harvesting. So you can have this indefinite carryover. So that means you can basically bring that loss from this year to the next year if you don't use it this year. And this is like tax loss harvesting, right? So when you sell something at a loss, it might be because you're trying to avoid paying part of the capital gains tax on something else that's grown. So this can be a strategy that you might want to implement, is this tax loss harvesting. But again, it's $3,000. It's not as nice as we'll see with real estate. In terms of real estate, there's just a tremendous amount of advantages in terms of the tax code. For instance, if you are selling an investment property and the proceeds that you get are kept in escrow, they're not even temporarily in your account. And again, you got to check the exact IRS guidelines on this, but you can identify another property. So you're selling one property to buy another property, like an investment property. You can defer or take a tax break. You can defer paying the tax on the gains from that first property that you're after selling. So you can just roll that into your second property. Again, you got to watch exactly how it's done, but 1031 exchange is very good. And often what happens is you can keep doing this property after property after property. Again, the properties have to fall within certain definitions. But when you pass away, that's it. You have achieved getting all the way to the end of your life without actually paying this tax. You've taken a break, you've taken a decision. I'm going to pay it later, I'm going to defer it, Again, keeping within guidelines. But the 1031 exchange is a phenomenal thing for those of us that like to sell properties and buy another one. Now, why would you sell a property? It could be that you're after flipping a property, you're after creating value. It could be that you're holding it for so long it's gone up in value. It could be that you are no longer receiving certain benefits from that particular property. You want to offload it from your portfolio. So again, the 1031 exchange is good for that. Now, I'm not really into selling properties. I'm more of a buy and hold. But one of the other things you have when you own these properties is if you have a rental property, you can claim a lot of deductions, in particular maintenance that you're doing on the property to maintain the property, certain utilities that are expenses as a rental property that you have to cover. Could be the sewer, could be, the electric, whatever that the tenant isn't paying that you're paying on behalf. And this is very applicable, let's say, for some short-term properties, things like that, where you're maybe short-term renting them, but even long-term rentals as well. A lot of the maintenance, renovations, improvements, things like this as well. And that'll go into a little difference between renovation and maintenance. But you can look at a chattel appraisal as well, where you can go through the specific aspects of the home, and that's what they really want you to do, is to go through each item that you've actually added value to the home, whether it's a certain system like the air conditioning, like the roof, like the windows, plumbing, electric, like structural stuff mostly, but sometimes cosmetic too, if it's significant cosmetic improvements or enhancements, but mostly structural. Now, above and beyond this, you have one of the best things in real estate is not necessarily the actual deductions, because, the deductions, sure, it'll be just once off, typically speaking, and it'll reduce your taxable income. But an amazing thing with real estate is the depreciation, the fact of the wear and tear in the home, and the fact that you get to work that into your home. So if you bought a home for $500,000, you can deduct a certain percentage of that every single year for 27 and a half years if it's a residential property, or 39 years if it's a commercial property. So that depreciation, that expense could be a few thousand every year. You can use that to reduce your taxable income. Depreciation is just incredible for real estate investors. And finally, something that is non-taxable is the equity. So in the sense, if you're not selling the property, the equity value could go up, because it could be that you basically improved and enhanced the property. You took a fixer-upper property and you increased the value through renovations. Or it could be that you've increased the rent on the actual building, especially if it's a multifamily property, and the way it's assessed or valued is a multiple of the actual annual rental yield. Well, if you increase the annual rental yield of the property, Now your multiple times that rental yield will boost the actual price of the property, since the gross rent multiplier is typically the price divided by the annual rental. So if you can increase that rental, annual rent, so if you increase the rent over time, that can increase the actual value of the property, in particular for 2 duplex, triplex, quadplex, so 2, 3, 4 unit and above properties, typically speaking. So again, it could be just you're forcing the appreciation like that, or it could be just market appreciation, not to do with you, but maybe there's been, increase in population, or the overall economy is doing better. Maybe it's inflation to a certain extent that drives up the actual home prices, but over time. And so long as you own that property, technically speaking, your equity is rising, and you can tap into that equity, again, above and beyond this video, but you could tap into that like a credit card, drawing on that collateral through something like a rental line of credit, or if you're still living there, a home equity line of credit, a HELOC. Again, the rental line of credit like an RLOC, and again, there's also things like business lines of credit, BLOCs, but that's above and beyond this video too. So guys, wrapping up, you can think about all these tax advantages. For instance, if you don't have a company, you can already take advantage of some of these tax loopholes. For instance, if you're a teacher at any stage, you have an educator's expense, $300 approximately a year, but there's plenty of other expenses. Now, of course, if you have a side hustle or a small business, then you can really turbocharge your savings and your tax savings. Then you can tap into things like home office expense, where you're basically getting a bonus for your utilities, your overall cost of living. You can subtract a percentage of your cost of living, and it'll reduce your tax bill every year from all your sources of income. You can also do things like your fuel, maybe depreciation, transport, car miles. You can also do things like certain meals, if there's business involved or just a discussion of business. If the goal of the aim is to increase the actual revenue or the profit of the business. So there's plenty of more tax benefits for those that set up an LLC. But even in terms of investments, right? You have your seeds or your plants, your investments, and you put them into a bucket, and the bucket, it could have holes, so you don't want to have a bucket with too many holes, right? So you really want to get the best bucket for your investments. So something like the HSA, the Marvel superhero, there's no tax in, there's no tax out, provided you're spending it on the right stuff. But even then, you have things like the Roth IRA, where you allow everything to grow tax-free when you take it out. Or on the other side, your regular tax advantaged account, your 401k, etc., where you didn't pay tax, at least on one end. You didn't pay your income tax, you're only going to be paying the capital gains tax. Of course, you want to take advantage of any employer match. That's free money right there, where your employer decides to match your contributions if you're working for an employer. But only then, after you've really maximized all these tax advantaged accounts, might you want to consider something like a taxable. Unless, of course, you want to tap that early, because, of course, it becomes more complicated to take money out of these other accounts like the Roth IRAs or the 401ks before a certain age. It's not impossible, and in fact, you can take out the principal from the Roth IRA, although it's not really advisable, because once you've taken it out, you can't put it back in for that particular year. It's gone. And for the other accounts, typically you pay a penalty if you take it out too early. Usually it's before 59.5 or something like that. So still, you've got these advantages in the investment world. And of course, there's tax loss harvesting. But with real estate, I mean, there you're talking about your maintenance, you're talking about your expenses, your deductions, your depreciation, which is wonderful, and of course 1031s if you're selling it. So a lot of tax advantages for those that are involved in real estate. Much more so than in investments in the stock market. So guys, if you found some value in this video and you thought it was helpful, consider subscribing to my channel so you never miss another Investing Professor video. It really does help the algorithm, and I do appreciate it. So thank you so much, you guys, and I'll see you on the other side.